Welcome to the Daily Drawdown, where today the pressure points are SpaceX, the Fed, and AI inflation. Three stories are driving the tape at once. SpaceX is being priced like an AI superplatform. The Fed just changed how it talks to markets, and AI capex is starting to look like a live inflation impulse instead of a distant productivity story. SpaceX is in violent price discovery right after the IPO, and the numbers across coverage are all over the place. Depending on which print you looked at, traders were talking about an almost $880 billion jump in market value, a fleeting $2.6 trillion headline valuation, and filings pointing closer to a roughly $135 billion market cap. That spread matters because it tells you enthusiasm is outrunning stable valuation anchors. Some commentary even framed it as briefly rivaling or surpassing megacap tech, while options markets started implying huge upside scenarios with low probability attached. At the same time, implied volatility has already eased from the hottest levels, and the stock also showed the usual post-IPO wobble with pullbacks after the initial surge. What to watch next is whether trading settles around fundamentals or keeps behaving like a meme-adjacent momentum name. The real bull case is that investors no longer see SpaceX as just launch and satellites. They see an AI infrastructure company with hyperscale compute, giant data center ambitions, and tighter control over GPUs, power, and networking than customers get from standard third-party cloud setups. The company and analysts are pointing to massive addressable market numbers, with the S1 citing $28.5 trillion and most of that tied to AI enterprise applications. That is why revenue forecasts are getting extreme, including projections that push annual revenue toward $1 trillion by 2030. The caution is straightforward. Those TAM figures may be overstated, and revenue assumptions that far out are doing a lot of work. Still, if the market keeps treating SpaceX as core AI infrastructure instead of a traditional aerospace business, the valuation debate changes completely. Management is acting like it wants to build the whole stack fast. Post-IPO, SpaceX announced aggressive deal-making, including a reported $60 billion all-stock bid for Cursor and purchases such as xAI, which points to expansion deeper into software and AI tools. There is also chatter around bigger combinations, but anything transformative would face governance hurdles and likely take years. Nearer term, the cleaner risk is ownership and lockups. Big institutions, employee tender holders, and vehicles like 137 Ventures all matter because staggered lockup expiries can create real selling pressure even if there is no full-scale dump. Index inclusion in the Russell 1000 and NASDAQ 100 broadens exposure into passive and retirement flows, which can offset some of that supply. Underneath all of it is capex, and the ramp is steep, roughly $463 million in 2023, around $5.6 billion cited for 2024, and about $12.7 billion for 2025. That spending is one reason SpaceX matters beyond its own stock, because it feeds directly into the broader AI buildout in chips, power, equipment, and labor. The second big shift came from the Fed. New chair Kevin Warsh moved hard away from the old communication playbook with a much shorter June 17 statement, less directional language, and a clear message that the Fed will stop leaning on forward guidance and the dot plot the way markets got used to under Powell. Warsh described the prior setup as a hall of mirrors and signaled more visible disagreement inside the committee and more ambiguity outside it. For markets, that means less hand-holding and more policy uncertainty between meetings. Even with that communication reset, the actual policy signal in the SEP was hawkish. The median funds rate projection rose to 3.8% from 3.4%. 9 officials saw at least one hike this year, and core PCE forecasts moved higher, including 3.3% for this year in one-sided read. Markets responded the obvious way. 2-year yields jumped, the dollar strengthened, equities sold off, and rate hike odds for September moved up. What matters next is whether Warsh's ambiguity keeps tightening financial conditions by itself, even before any additional rate move. Warsh also launched 5 task forces on communications, balance sheet policy, data and real-time information, productivity and jobs, including AI and inflation frameworks. The important point is that he wants the Fed using more private sector, real-time, and AI-assisted data because he thinks the standard national accounts arrive too late. That lines up with the inflation problem now coming into view. Multiple analysts argue AI capex is not just future productivity investment, it is current demand pressure. Data center buildouts are pulling on chips, memory, electricity, construction capacity, and skilled labor right now, while supply catches up later. That is why hardware names and semis keep showing up as winners, from NVIDIA to Micron, Applied Materials, KLA, Lumentum, and Western Digital. If this read is right, AI is disinflationary later, but inflationary first, which is exactly the kind of sequencing problem the Fed has to manage. On the balance sheet, the Fed is still signaling ample reserves and no rush into aggressive runoff. Warsh appears to prefer light normalization over anything that would force long-term rates sharply higher, especially after reserves and the balance sheet have already risen since December. That caution sits against an economy that still is not cracking. May retail sales beat expectations at plus 0.9% month over month, with core sales still positive after stripping out autos and gas. Consumers are holding up despite higher fuel prices and mortgage rates, helped by wages and asset values. Oil is the near-term inflation watch. The Strategic Petroleum Reserve is down near 340 million barrels after a sharp draw. The Iran backdrop is keeping short-term supply risk alive, and pump spending has been running strongly year over year. So even if long-run demand forecasts soften, headline CPI can still get pushed around by energy in the near term. On regulation, the G7 is still leaning toward voluntary cooperation rather than hard law. Frontier Labs agreed to a voluntary 30-day technical review and advance notice process for new Frontier models, but recent model withdrawals exposed obvious gaps in enforcement. That keeps the policy direction loose for now, but the bigger risk may be politics rather than regulators. Commentary is increasingly pointing to a backlash around jobs, with the possibility that candidates in both parties start campaigning on slowing or restricting AI deployment if displacement becomes more visible. One geopolitical note worth watching is the Iran memorandum. The reported 14-point framework includes supervised, downblending, and a large reconstruction incentive vehicle, but critics say it lacks precise nuclear prohibitions and credible inspection and enforcement mechanics. That matters because vague language plus public threats to resume bombing make the diplomatic track look fragile, and any breakdown feeds straight back into oil risk. That is the setup. SpaceX is being repriced as AI infrastructure. The Fed is choosing ambiguity, and AI demand is colliding with inflation reality. This is the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.